Hey there, welcome to another episode of Fast Forward, a podcast from QSR Magazine. My name is Sam Okus. I'm the editor of QSR and the editorial director of Food News Media. Here we are, the final episode in the 5-part Restaurantology series. By now, I hope you've had a chance to check out all 4 of our previous episodes. We've covered a lot of ground, from the role that hospitality plays in emerging stronger from the pandemic to unique growth strategies for emerging operators in today's post-COVID environment, to how to prepare your brand for an acquisition and land the right investment partner. All of these interviews will remain on demand at the Fast Forward podcast feed, which again, you can find wherever you listen to your podcasts. And you can also check out video of all of these panel discussions at savoryfund.com/restaurantology. That's restaurant, and you can also learn more about Savory there. You're going to learn a lot more about Savory here as well on today's episode, as I'm talking with Savory's managing partners, Andrew Smith and Greg Warnock. Trust me when I tell you that this session today is going to be chock full of valuable and practical insights for leaders of emerging restaurant brands. It gives a very detailed glimpse at how investors search for smart investments, what kind of opportunity they see in the restaurant industry today, and the things that they think that restaurant leaders should be doing today to set their brands up for a potential investment deal. It's been such a pleasure to dive deep into the expertise of Savory's leadership all week this week through the Restaurantology series. Please remember to check out the whole archive, again, at the Fast Forward podcast feed on Apple, Spotify, or wherever you listen to your podcasts. Or please go to savoryfund.com/restaurantology to stream the videos on demand of these panel conversations with Savory's leaders that we have been doing all week. Before I jump into this session, as always, go to qsrmagazine.com for all the news and insights you need on the QSR and fast casual restaurant industries. And please, again, feel free to email me anytime you want to talk or just share your perspective, sam@qsrmagazine.com. All right, I'm going to roll now into this last conversation in the 5-part Restaurantology series, this one with Andrew Smith and Greg Warnock, the managing partners behind Savory Fund. Okay, Andrew, Greg, thank you guys both so much for spending some time with me today. This is our final installment of the Restaurantology series. So as a little bit of catch up, I have talked with all of the brands now, the founders of the brands within your portfolio. We've talked about how the brands have pivoted in the midst of the pandemic. We've talked about the opportunity that lies ahead for the restaurant industry. And, we talked with your 2 new investments about what that process was like, what the acquisition was like, setting their brands up for getting this deal. And now with you 2, I want to dig a little bit more into Savory, what you're hoping to accomplish with Savory, and maybe some of the things you're thinking about financially, and why the restaurant industry seems to provide such a great opportunity as you see it, why that seems like something you guys really wanted to invest heavily in. So Greg, I want to start with you. If you could, again, we've talked to a lot of Savory leaders at this point. We know a little bit more about what Savory is doing, what that portfolio looks like. But Greg, you as somebody who, with Mercado Partners, you helped launch this Savory Fund. Can you tell us a little bit more about what Mercado Partners is and why the Savory Fund was something you guys got off the ground?
Sure, I'm happy to. And Sam, thanks for having us on the podcast. Really enjoy talking about Savory and Mercado, of course, and happy to provide this background. I'm a technology investor. I'm a software engineer by training. I've been in the tech space most of my life. And I think the common thread between my investing history and Savory really is entrepreneurship. And restaurateurs are unique in some respects relative to their entrepreneurship. They really don't join the industry for fame and fortune. They don't kind of map themselves to the iconic tech billionaires and think they're on that path, which is a more common misconception that maybe tech CEOs have. They really have an affinity for a culture or a flavor profile, and they just want to bring it home to the neighborhood. They most often stand up that first restaurant to share something that's important and personal to them, and that really resonated with me. As Andrew and I began talking about the possibility of, developing a unique investment practice in the restaurant industry, it really was his background blended with my sort of investing perspective that made it possible. Andrew was a tech entrepreneur, as you probably know, before his stint in food and beverage. and he was definitely one to watch here regionally. And because of that, we became friends. And those conversations led to sort of these exploratory dialogues around, if we were to be investing in food and beverage, how would we organize ourselves differently? How would we deliver value differently? And what would be unique about our offering? And, pulling our two minds together and our best creative effort, the result of that is Savory. And it's been really wildly successful. I would say beyond our imagination.
Mm. Andrew, you come now with an operational background. You were an operator before you guys launched Savory Fund. You know the food and beverage space very well, even though you yourself also got to start in technology. And I'm wondering if now, from that perspective, what was the opportunity you saw when this idea came up for Savory Fund? Why was that such an attractive proposition for you, knowing what you knew from the operator standpoint?
Yeah, I think it was just that. I thought, at the first couple of years of my operating history and being a restaurateur, when you're really busy and you're in the business, you can't work on the business. And one of the things that you have to do to be able to scale is you have to work on your business. And one of the things that you need to be able to scale your business is a good capital structure. You need to have investors, you need to have investment, you have to have banking relationships. It's very complex. And so for me, that was one of the components that helped us scale, is we actually had some good financing and good backing in that realm. There's no better backing out there than to have someone that's a beloved investor, someone that's behind you 100%, and that wants to see you be successful every step of the way. And knowing Greg, he's really one of the leaders in venture and private equity financing here in this region, and has been for the last 3 decades. Have had a relationship for many, many years prior to the Savory Fund being started together. When he approached me and said, there's got to be a better way taking all of your operational prowess as a team and combine it with our operational prowess within the private equity realm, and let's do something really, really special. And that's really what caught my attention, is if you take the goodness of what we've done over the last 12 years and all of the experience that we have and combine it with private equity, you have something special. It doesn't exist. It's something that I wanted when I was an operator with my partners. We wish we would have had a Savory at our doorstep saying, we can bring experience, we can bring a playbook, we can bring money, and we're going to do it with you, not just watch from the sidelines.
Mm. It's interesting. I mean, Greg, you talk about this notion of food and beverage founders. They have this passion. They want to serve their communities. It's kind of a cliche in the restaurant industry of, romanticizing the idea of operating a restaurant. And that it tends to be why so many restaurants fail. And, restaurants in a way are kind of a famously bad investment, at least in that they have a very razor thin profit margin. And to your point, you're not getting in this for fame or fortune. So from an investor's standpoint, why do you still see that opportunity? What is it about it that you feel like could be different with, Savory Fund being that resource for your brand? Greg, I'm interested, maybe get your perspective, and then Andrew.
Well, I think each investment target industry has its own inherent risks. And in the food and beverage industry, I see them in 2 places. One is at that initial nascence of a new brand, like that first restaurant, and how does the community respond to that? Humans are fickle. It's difficult to unpack and understand why they would frequent a particular restaurant and make it part of their habit or part of their routine, and why not another. And sometimes it comes down to convenience and value and price and flavor and smell and the relationship with the restaurateur, the owner. It can be a variety of things or many things in concert, but it's very difficult to predict. So I think the restaurant industry fairly has received a reputation of quite a bit of uncertainty around how will this concept be received. But you see, once a restaurateur takes that idea and develops it to the point where they have 5 or 6 restaurants and they're 8 or 10 years into it, it is a vastly different risk profile from an investment standpoint. The go to zero risk has really been scrubbed off. The liability of a newness has been removed. The community acceptance has been demonstrated, and I think fundamentally the investment proposition is different. But then you're facing the second, what I would consider sort of a nexus of risk, and that is, what do I do now? These restaurateurs, I think, in my view, and it's just my perspective, they don't think as long term. They have this goal to share this feeling they have, this sentiment they have, this folklore, this this culture. And they don't think about, well, what is the end game? They really think about, I'd love to get to the point where I'm sharing this. And then one day they are sharing it and they have 5 or 6 locations and they're successful. And all their nieces and nephews work there. They're sort of neighborhood oriented. All the locations are within 50 miles of their home. And then there's that moment where they stop and think, what have I created? And is it valuable? And can I sell it, for example? Or can I transfer it to my children? What do I do now? And they realize they're a little bit stuck because what got them there, which is extraordinary attention to detail, that dining experience, that feeling, that culture, is not what will get them to something that's economically a huge and valuable win for themselves and for their teams and employees and for the community. They have to kind of take that restaurant brand to 30 to 50 locations. And the reason is anybody that can afford to buy that restaurant, let's say at 5 to 7 locations, somebody who has the money to write a several $million check probably will buy something else that is more conducive to absentee ownership. They didn't accumulate their $5 to $7 million that they can write that check with by not working hard, and they don't want to work hard, later in their life. So they'd look at the restaurant and say, I could buy this and it is profitable and it would be a fair price, but do I really want to work every Friday and Saturday night, every holiday? And do I want the complexity of several hundred employees who are pretty youthful and experience high turnover? And so they just go buy something else. And so these restaurateurs who have 5 to 7 locations find it very difficult to monetize that asset. And now think about the journey of what got them there, which is attention to detail and curation of a dining experience, and what will take them to 30 to 40. 30 to 40 is thousands of employees and tens of locations, and opening locations 500 miles from your house and having sort of systems and process and procedure and delegation and governance. And those are things that in many cases they're unfamiliar with. And that's why Savory is kind of an unlock, is because Savory has those skills and can partner with the restaurateur in a way that says, if it happens inside the dining hall and it happens to the customer, then continue to handle it as a founder, because that magic, whatever that is, that's difficult to describe and difficult to assess, but is obviously here. We want to be able to wrap our hands around it and protect it and preserve it and develop it. And everything that's outside the dining hall or the restaurant, site location, identification, entitlement, construction, project oversight, marketing, sales, loyalty programs, technology, recruiting, hiring, training, mid-level management, kind of preparing for a private equity transaction or a sale or a harvest, all of that is often beyond their experience set. That's the piece that Savory brings to the table. So maybe that will help you understand why I think it's a unique experience. If you can manage those 2 points of risk, how do we get past that initial restaurant adoption? And then how do we get past moving from, we now have a curated brand that's very successful, and moving it into scale. And Savory is really focused on those 2 things, letting the restaurateur answer the first question and letting Savory answer the second question.
Yeah, it's interesting. Andrew, anything you want to add to that?
Yeah, I think the only thing I would add based on your original question, Sam, is that I really do think that what Greg said as far as having an undeserved reputation, it really is true. I remember being in tech and thinking, I'd really like to build a restaurant and own a restaurant. I'm from Chicago. You eat out 3 squares a day. It's something that you enjoy. It's part of your lifestyle. And I always had kind of an affinity. I would call myself a foodie. And I thought it would be fun. You romanticize it in your head. And then you open the first one, you go, what in the world did I just do to myself? This is so hard. But the one thing that I absolutely loved from my tech days was the pace at which you can move in tech and the excitement of creating something and changing a vertical within a market space that you're in. But it's extremely expensive, and you're trying to prove your product, and a lot of times you burn cash for years until you prove it. The thing that was fascinating to me with this industry, and it still remains today, 13 years later within this industry as I've been in it, is that you have such controllables. You have revenue walking in the door that day, and what you need to do is focus on a few controllables that you control and that your team controls. And if done right, there is margin there immediately, day one. You can make a profit in this business day one if managed correctly. So I do think that it's got an undeserved reputation. I do think it's an industry that, if done correctly, is extremely profitable, extremely value creative. And I think that with Savory and with what we put together, we've identified a way to get the creation of that value with these beloved brands in each of these regions to really hit that next level under our watch.
What is the ultimate goal then? I mean, you guys are targeting, I know, like 2 to 10 unit concepts, emerging concepts, truly with lots of potential. But what's the ultimate goal in terms of how you guys take these brands and develop them, and then what?
I think, Greg, your goal is to be a chef, isn't it? To be on the line in one of our restaurants.
Selfish ambition. You're just trying to get the restaurant to become a chef.
No, if I were to answer that question, I would say that, ultimately we're trying to create assets that are valuable, restaurant brands that are valuable and beloved and respected and growing and thriving. What happens next involves sometimes a buyer who's aggregating locations and brands, sometimes a financial buyer. We might hold some longer than others if they're showing great promise, growth, and profit. I've always felt like as an investor, you can't really control the ultimate harvest or outcome because it requires the participation of other parties, whether those are public markets or private buyers. What you can control is the quality of your asset and your readiness. And so when we think about it from a Savory standpoint, we're going to really build a high quality asset, and we're going to be ready to partner with others or transact with others if that energy exists. But other than that, don't really. I don't think it's a wise idea to architect for a particular kind of transaction, but really to build value and be ready.
Gotcha. So yeah, go ahead, Andrew. You want to add to that?
No. I was just going to say I can't really add to that because the idea of being ready. The only thing that I would say is we just enjoy what we're doing, enjoy the journey, and the thing that Greg and I have really been overwhelmed with is that as we scale this business or each of our portfolio businesses, the amount of good we can do in communities we serve, the amount of jobs that we're able to create, the amount of high-paying leadership positions that we've been able to create between now and when the business is ready or that there's an opportunity for harvest, if that should come for different brands within our portfolio. We're just excited about the journey of Savory as well.
Mm. All right, you guys launched Savory early in the summer, of course. At that point, we were a couple months into the pandemic. We've seen a lot of M&A activity through the pandemic for one reason or another. I mean, there is a lot of opportunity here, and folks like yourself are seeing that opportunity. So tell me a little bit about what your perspective is on the food and beverage industry today, especially considering the pandemic. What opportunity has it created for an investment firm such as Savory?
Maybe I'll lead out on this one. What I'm about to say applies to food and beverage, but it really applies to every industry. When an industry experiences upheaval or turbulence or change, it creates opportunity for challengers, and it erodes the position of the incumbent. Okay, so, and here's why that's true. And you can think about it in the food and beverage industry. People start changing their patterns a little bit. So let's say because of the pandemic, my driving pattern is different. My work pattern is different. I used to be eating near my office and now I'm eating near my home, or it could be that simple or it could be more complex, but it's changing. And because it's changing, your mind is open to considering new things. And so the embeddedness of your buying habits is now loosened up and you're ready to consider new things. That creates an opportunity for the challenger, for the new entrant to show you something new and give you a different experience. That's true in tech, that's true in real estate, that's true in food and beverage, it's true everywhere. So these times, these pandemic times, even though on one level, it's a tragedy, it's a human tragedy, it's a complicated issue, it's difficult to navigate, but from an investment standpoint and from an entrepreneurial standpoint, it's a tremendous opportunity. Your criteria for choosing where you're going to eat has changed. Maybe you didn't care about drive-thrus and now you do. Maybe you didn't care about seating distances and now you do. Maybe you didn't care about the reputation for food safety and now it's maybe top of mind. Maybe the staff and the way they handle you and what they wipe and when they wipe it and what they wear on their faces and on their hands suddenly matters. So your patterns have changed, you're open to new ideas, your criteria has changed. And now the new challenger has a chance to make a case for themselves. And Savory always funds the challenger. Savory always funds the challenger. So there are more challengers, there's more opportunity. The balance sheet becomes a competitive weapon where it wasn't a couple of years ago. Some of the companies that haven't responded as quickly to the pandemic have now eroded their balance sheets and are in weakened positions. They can't market as much, they can't innovate as much, they can't buy new equipment, they can't change locations or build new locations. And the folks in the Savory portfolio can do all of those things. They have unlimited funds to be able to pivot, respond, attack, be nimble, show new strategies, show new products, show new menu items, show new methodologies, new marketing strategies, new delivery strategies, new technologies. So I'm kind of rambling on here, but I'm telling you that the market opportunity caused by the pandemic is a tremendous opportunity for Savory and its portfolio partners.
Andrew, especially for you coming from your background, having that operational expertise, what is your impression of sort of where things are for the industry today? And then sort of follow up for you again, why do you see this opportunity now?
Yeah, I'm going to take a little bit of a different angle just because of when I entered the industry. I entered the industry when there was this term being thrown around, Sam, called fast casual.
Yeah.
People think fast casual, I'm like, what the heck is that? There's fast food, there's casual, and there's fine dining. What is this fast casual thing? And it's funny because I don't think you could find a 5-year-old kid that wouldn't know what fast casual means now, right? I mean, it's just
right.
part of our culture. But I entered the industry in 2008 when there was a huge recession. Banks had crashed. It was a very tough time for many families in America. You fast forward to now, and of course, Greg and I never planned on raising a fund and having a fund close in the middle of a pandemic. A cycle is a cycle, and I would much rather have this be a typical cycle that we go through where there's a recession and businesses have failed because they've over-levered or whatever. I mean, there's loss of life, and that's extremely difficult to watch, and how this has really just shuttered so many businesses that did have a chance prior to the pandemic. But because we're in the middle of the pandemic, I would say it reminds me a lot of the 2009 to 2013, 14 time in my mind that there is so much opportunity for good to not only rebuild, but to rethink what the market's going to look like, feel like, and really within this industry, serve like. Because there's a very different service level now, like Greg just reviewed, and I don't even have to repeat it because he did it perfectly. We have to think of everything differently. And when you think of things differently within this industry, great things come out of that. I think that there's going to be some innovation that no one have ever thought of prior to the pandemic hitting. I know that within our teams and within our different portfolio companies, new ideas are coming up every week that would never have come to the table should a pandemic not have hit us the way that it did. So for Greg and I to have not only the fund, but the support of our LPs regionally and nationally, really looking at this industry as opportunistic, it gets me excited that the industry still has so much good that not only can we fund, but that we can also lead out and show to others there's a great industry here to be had, and there should be a lot of people looking at it because it's exciting.
Yeah, I'm glad you brought up that comparison to the recession, because it does seem like there is a lot of overlap and lessons that can be learned in the middle of this. That, I mean, a lot of people in this industry were around for the recession. So in some ways, they've probably taken some lessons from how they navigated through those challenges and applying them to today. And a big part of the recession, of course, was financial hardship. I mean, just the state of the economy and the challenges that posed for business owners as it related to their finances. And so I'm curious from you two about what you see as being maybe some of the more common financial problems that restaurant operators are facing today, with or without the pandemic. I mean, when you have a restaurant operator who has a couple restaurants, has great potential, but what are those things that they typically, trip over themselves maybe with, or the hardships that they can't find their way around, that you guys especially feel like you can come in and help them with that? Andrew, maybe let's start with you.
Yeah, that's a great question, because we have had the good fortune in the middle of the pandemic to not only meet with, also communicate with a little over 400 different restaurant groups, 400. And so we've had a good swath of opportunity to talk to different flavor segments, different locations within the US, and everybody has a commonality, and that is they're dealing with the pandemic. The one thing that I see, though, is that most of these restaurateurs in these groups feel that the opportunity is ahead of them, and it's not, of course, behind them. But they have to learn from what was behind them. And as I look at their business and their business model and even their financials, there's something that they're missing. And that is, you can't be undisciplined in the decisions that you make at any time. And I think when you say before the pandemic, what are some of the things that they should have probably done? Well, I think that they still remain today in the middle of the pandemic, and that is be disciplined. And when I say discipline, don't overpay for a piece of real estate than what you think you really can afford, because that's going to follow you for 10, 15 plus years. And we're seeing that right now as we look at financials with brands, that now their sales have gone down 20%, and maybe they've even come back up to maybe flat, but they're now dealing with more labor costs and more supply costs and everything else. their rent is crushing them. And so don't get into a lease deal that you think is going to work itself out, or just because it's A++, you're going to always get A++ sales. Secondly, you got to make sure that you know the cost of your goods. I think that there's a lot of brands out there that they really have not optimized their menu. And the thing that the pandemic has created is this opportunity to sit down and say, should we really be selling this product that has a $55 food cost just because it's who we are and we love it? Well, why don't our customers love it, and why don't they buy it more? So menu optimization, being disciplined on your rental costs, making sure that you're paying for good talent and that you don't have a bunch of talent that's not good hanging around because you don't know how to let go of people. Now this has forced you to have to do that. And I think that moving forward, I think we're going to see a lot more disciplined business processes put in place. That's what we're doing with our portfolio companies. And that you're going to have to stick to them because there's margin to be made, but you got to remain disciplined.
Greg, anything you would add to that?
Yeah. So Andrew's answer is kind of tactical. Let me share a thought or two that has to do with mindset. As you go into a moment like this, mental agility and flexibility and adaptability become really essential. You're going to see swings in your labor costs and availability, swings in your revenue demand across locations and through geographies, and maybe a pattern shift from offices to out into the suburban areas. And so they're going to be at greater scale than you've experienced before. And how do you adjust for that? It's an axiomatic truth that if you adjust your costs to match your revenue, you'll remain profitable. But why don't people do that is because they're kind of hopeful that this thing will pass quickly, that I'm seeing it accurately, that I'm forecasting it accurately. And this mental flexibility that says, I'm willing to let go of what used to be, and I'm willing to embrace what is, and then deal with what is in an ambitious way, a very fast responding way. I think that gives you kind of an opportunity. You're going to have more costs in food safety than you had before. Your labor and food cost balances are going to shift. You might have to change your open hours. You might have to close your lobbies. If you respond slowly to those changes, and if you're mentally hopeful that it's an episode and it will pass quickly, those are the things that can be fatal. If you respond very quickly and with agility and with optimism, and maintain your cost structure inside your revenue envelope, then ultimately you'll be fine. So there's something about mindset as you respond to these sort of drastic economic shocks that are sort of external to your business as well.
Yeah, it's interesting. So most of the people who are probably listening to us talk right now are restaurant operators. Probably a lot of them are emerging restaurant operators. And I got to tell you, when I interact with emerging restaurant operators, I often get the question about how do I find an investment partner? What do I have to do to get that private equity or to find these resources in investment to help to supercharge my growth? And here you guys are. This is what you do. This is where you come in and you provide for these great brands with great potential, and being able to help them be able to fund that exciting growth that they have coming ahead of them. But the relationship, I think, probably between business and private equity is, it's, I don't know, it's probably challenging, and it can obviously work beautifully, but there are some times when it doesn't necessarily work. And we see lots of failures in those partnerships in the history of the restaurant industry, really, especially. What do you guys think about sort of the state of private equity and investment in the restaurant industry? What do you think are maybe some of the misperceptions that restaurant operators might have? And what would you say to these emerging brand operators about how they should approach potential investors and trying to bring them on as a support for their business?
I heard a couple of things in your question. One is sort of what is the state of affairs? And I would say the state of affairs is that private equity has recognized the investment opportunity in food and beverage and is coming that direction. So private equity has always had some favorite industries, tech, biotech, and so forth. And the restaurant industry or the food and beverage industry has been sort of the underserved, secondary market for investment. And we've talked about the reputation, but I think that's changing. If you look at over the past 4 or 5 years, dedicated funds focused on food and beverage, sleeves inside other funds that are dedicated, that have an allocation for food and beverage. large corporate investors creating venture programs to help drive innovation that will support their supply chain activities. So there's innovation around supply chain, there's innovation around product, there's innovation around distribution, there's innovation around food and beverage, and it's all being funded at a scale much higher than it was, let's say, 10 years ago. So even those kinds of shifts are slow. I think my first word to the restaurant industry is capital is coming your way and will become more available in the future than it has been in the past. You also mentioned something about how does a restaurateur prepare themselves, or how should they think about it? And unfortunately, I have to say that our industry doesn't always behave in the way that would make us all proud. And here's why. The restaurant industry is staffed by these people who are driven, by and large, these are global sweeping statements, by a desire to deliver an experience to a community. That's what drives them. The private equity industry is driven by people who want to make an investment return. And so it's often blended with greed and with arrogance, and the kinds of things that they talk about at the dinner table are about, how and when are we becoming billionaires? And the kinds of things that restaurateurs talk about at the dinner table are, I'm working on this new menu item. Let me share with it. Let me have you have a taste. And I'm thinking about opening up a restaurant in this community, and here's why. It's just different. And as those two industries come together, there's going to be some friction. You're going to have all these type A personalities, these MBA types, these armies of analysts, looking at projects. And over here, you have this very qualitative, artistic, creative community. And as those two come together, there's going to be friction. And it's unfortunate. I wish I could do or say something that would be a magic, solution to this. But my advice to restaurateurs would be proceed with caution. Think about it as a relationship. Think about it as a friendship. Think about it as something that you're going to participate in for, 5 or 7 years, maybe 10 years. It's the beginning of a deep and abiding relationship where you'll be working very closely with a person for a long period of time. It is not transactional. You shouldn't think that I'm going to deal with this person for a week or two and then we're going to be on to the next. A financing like this, a financial partner, is a lasting, enduring relationship, should be entered with caution, and a lot of focus should be on, what does this feel like? What are the patterns of these communications? What is the level of my trust and comfort as I'm having these interactions? What kind of questions are they asking? Do I believe they care about me and my team? Do they care about my community? Do they care about what we're delivering to the community that surrounds us? And I think those are the things that are as important as, what does the deal structure look like, and what is the price, and what is my attorney telling me about the third paragraph on the 7th page? It really is about the relationship, and I would lead with that mentally if I could give advice to the industry as a whole.
Andrew, what's your advice for folks looking for an investment to help their growth?
My advice is interesting because I've been on the other side of the table from someone like Greg. And so I totally understand how it feels to be nervous about that journey, to get into a relationship where it's going to be this long-term relationship. And I think that the fear, and I think that one thing that Greg alluded to, is that there's this fear, there's this tension there in your mind that Greg and I are going to come into the business and we're going to change your spice. And we're going to say, you can't use ranch dressing, you have to use balsamic dressing on all your salads. It's kind of this ludicrous thought process that I think everybody that's an operator or a founder, I've been a founder of multiple businesses before, that you think this person or this group is going to come in and change everything that I've created that's dear to me. It could not be further from the truth. Now, I'm not going to say that there's not individuals out there that are those investors. And so I like how, Greg, you said, proceed with caution. Make sure that who you're getting into business with, that you ask those tough questions. But when asked of Greg and I, we're like, we don't know anything about your spice. We know it tastes good, and we think we should keep using that. So that's one thing, is that change is going to happen, but not where it matters mostly to, especially in this industry, to the restaurateur or the founder. I do think that private equity has an undeserved reputation, just like private equity kind of had this undeserved reputation of the food and beverage industry, right? I think it goes both ways. It cuts both ways. And I think the reason why is because there's this fear of that change, or that they're going to come in and screw things up. If I can just pull in one of our portfolio brands, because it was the most recent, I remember being on a call with Greg, with Brandon and Zane Hunt with Via 313. And I don't know if it was paragraph 7, Greg, that we were talking about, but it was paragraph 7 or 3 or 13. And we were talking about some little point in the deal. And there was one point in time that Greg said, guys, it really does not matter to us what that says, because we're going to be in this relationship of trust, and we're going to have so much fun. We're going to do so much good together. We're going to create via 313 shops all across the nation. And at one point in time, you're just going to have to say, you know what, you're right. Let's just get into a relationship and let's go. Let's move. Fast forward a month after that, and Brandon Hunt says, I wish that I could just kind of see what it would be like right after the transaction, because this has been unbelievable. It's been everything that you and Greg said. This is a partnership. I feel like we've been partners for years, and that you actually care about my brand like I do. So I just think that right now, the perception that you have to have if you're listening to this is there's good people out there also that love your brand and would love to help you. What can you do to prepare for that moment in time? Be very disciplined in your business to create an incredible business. Create that cult following. Be really disciplined in the decisions you make so you can be profitable. But make sure that when the moment does happen, or that you do have that opportunity, make sure that you're loud. Make sure you're noisy. Make sure that you're known. Put your voice out there. Talk to people like Sam at QSR and tell them what you're doing so you can get your voice out there so that Greg and I know about you and others that are in the. That's right.
I like it.
Everybody email Sam and he'll get you to us.
There you go. Well, you said that word trust, and I it's interesting because, this reminds me of sort of the relationship of franchisors and franchisees. People talk about if they don't want to franchise their brand, they use this term, well, I don't want to give up control. And so it sort of seems like we're talking about the same thing here. You mentioned that relationship of trust seems to be all about control, and they might have this notion of you guys coming in and trying to take control of their brand. And I imagine that's not what you guys want to do, but how do you walk that line? Because clearly you do want these brands to success and you do have some operational know-how, but how do you walk that line where you're not wresting too much of that control from them?
I'll jump in on this one. It feels to me like what people really want, all humans, whether it's on the investing side or on the entrepreneur side, they just want to feel like they've been heard. They want to feel like they've been heard and their views have been validated and considered. So we really go the extra mile to make sure that we're in dialogue with these entrepreneurs all the time. We do technically have control of the business. We have a majority stake. And I think whoever is signing the leases and guaranteeing that work and taking the financial risk needs to be able to control and protect that investment. So that's what makes sense to us. But it is also important for us that the founders have a sense that the magic that got us to this point is magic that they understand, and they understand it deeply. They understand it in their bones. They dreamed it up, and we need to be careful to preserve that and deliver that to customers on a repeated basis. So for us, the division is sort of like, are we talking about new locations, technology, equipment packs, lease structures, guarantees, finance, debt, or are we talking about foods and flavors and smells and experiences and the menu and pricing and those kinds of things? And we actually build two different boards. We have a business board and a brand board, we call it. And that helps us delineate between, what are the elements that relate to the dining experience and make sure that those decisions are made in a different context and in a different way than the decisions that are made relative. For example, are we going to borrow money in this brand and how much and at what rate?
Andrew, what do you think about that?
Yeah, I think that what Greg said is probably the thing that we all want. We want to be heard. Who doesn't want to be heard, right? And I think that we've done a masterful way, structure of making sure that our founders and their existing teams, when we get involved in that business, are heard. And because of the two boards that we have, that gives them that comfort pre-deal, but post-deal, I think that the constant communication that we have with the founders, that we actually want them involved in the decisions and what we're doing and decisions that we're making as a team. And I think that them being heard and the communication that we have constantly with our portfolio brands makes them relax and realize this is just a team effort. So, this morning alone, I talked to 3 of our 5 portfolio brands already before this call within, the first 2 hours of the day. We talk with our partners constantly. And because of that, I feel that the relationship makes it feel like there's not a control. They control, Andrew and Greg make all decisions, and we just have to do what they say. There's this respect both ways. Who cares what the cap table says and how much percentage who owns what? It really matters how they feel, and they feel respected. And we don't want to do this without them anyway. I don't think we could do it without them. And that's why we're very founder-centric. We want the founders to be along with us. We don't want them to stand to the side. If there's founders that have contacted us and said, hey, I've got this great business, I've been doing it for 20 years, and I want to turn it over to you, and I want to retire, we actually don't even look at those businesses necessarily. It's not that we never would, but we want to do the business with the founders right by our side, because Greg and I don't know what they've done to get it to that point, but we know that we like it.
So we've been spending all of this Restaurantology series talking about how the pandemic has changed things. Of course, it has changed things a lot. And in many ways, I think it's changed things for the better for the restaurant industry, in terms of there is going to be some opportunity on the other side of this. But, considering that change, I guess, what do you guys think the primary change has been to the food and beverage industry, and how is it going to affect what kind of brands you look to invest in with Savory?
I'll go on that one, Greg, if you don't mind. I think that for us, the fast casual industry is still extremely appetizing to us, no pun. But we like it still. It's still very versatile. It's very recession and pandemic proof in many aspects. But we, as you know, because you've talked to our partners, we are betting on the fact that people are going to come back into the restaurants. And so we invested into Via 313, which is full service. And so for all of your FSR listeners, we believe it's going to come back. For all the QSR guys, we still think it's very strong. And I think it's a market that we have to be paying attention to. And so we think that we're going to have a very well-rounded and diverse portfolio of brands in the QSR, FSR, and maybe even uphill a little bit more on the casual dining. So we think that they're resilient, and we think that they're still going to be strong even after the pandemic passes us. And we hope that that's soon.
Greg, what do you think about how this industry is changing and how it might influence the way you guys are thinking about things?
Well, I think there's a dial-up on the importance of food safety. It is now mission critical. There is a dial-up on value. There is a dial-up on convenience. There's a phrase out there called the Amazon effect, but there's kind of an Amazon effect in food and beverage. We're sort of used to pushing buttons on our phone and making things show up at our house. And so there's a dial-up on technology. There's a dial-up on off-premise. There's a dial-up on delivery and convenience and at home. And we'll see how those things play out. I'm not sure that I see as many on the dial down side, because some of those might recover. I don't know how permanent they are, but there's probably a dial down on large dining hall. But it remains to be seen. From an investor standpoint, I'm willing to wait and watch certain segments of the market and see how they recover. But the investments that we'll make in the next, I'll call it 18 months, are going to take into consideration food safety, simplicity, replicability, convenience, sort of technology, deployment, uniqueness, a unique positioning in the marketplace. Those are the considerations that we'll have more front and center than we would have maybe 2 years ago.
It's so interesting. You guys are both from the technology side of things, and it's obvious that the restaurant industry is, I think, just in its infancy of a major technological makeover. I mean, the industry has been already heading that direction the last couple of years, heading in this direction where, digital ordering and, off-premises stuff is all fueled by these great tech platforms and what is possible with technology. I really only think we've only scratched the surface. When you think about the future of the restaurant industry, especially as it relates to what tech is doing and what doors it's opening, what's most exciting for you guys? What are you watching in terms of innovation that gets you really excited about the industry?
I'll just add my 2 cents, Greg, and I'd love to hear what you think, since you haven't been in the industry as long as Sam and I. But the thing that's crazy is I think back in 2008, 9, 10, we were receiving orders via fax machine in our restaurant, Sam. I mean,
right.
It was literally curling off, and then they ball up in the little wax paper. You'd have to open it like a scroll and see what the order is. You fast forward in this industry, and it's just unbelievable, the innovation over the last 5 years alone. And then literally since the pandemic has hit, it's crazy to see how the tech companies have pivoted to really go really deep into the business and the organization to support us. We're both extremely excited to see that, because we are technologists, Greg much more so than even myself. And I think that it gives us a lot of opportunity to get revenue or to generate revenue at brands that we never did in the past. I think that the industry is leaning a little too fast and a little too reactionary to going full digital, everything digital, no dine-in, no experience, just very cold and sterile. And I think that that's not the direction that the ultimately consumers want. But Greg and I are actually very open and interested in looking at food tech, and have looked at food tech and are currently looking at food tech to be part of the Savory portfolio, because we believe that there is a future here within the industry as it's running at a rapid pace for innovation.
So I see a shift in human buying decision-making behavior. And I think 15 years ago, maybe, when the notion of, Google is going to watch your moves and your mouse clicks, and they're going to adapt their marketing strategies to your behavior, it was pretty unsettling to most of us at the time. We thought, oh, that's kind of Orwellian, and I'm uneasy with it, and I wish I could turn that off. I don't want somebody predicting my appetites and demands. And now, in today's world, we've all become very much used to that and very accepting of it. And actually, we prefer it. I remember back in the day when I used to see ads on my browser for, cowboy chaps and water skis and Q-tips and feminine products. And I'd be like, wow, you know what, this is an absolute waste of my time. And now I see things that are preferences to me. And even though I know it's being contrived in the background, I sort of appreciate it because I feel like it wastes less of my time. So take that notion and bring it to food and beverage. And that's what I think is the interesting, out year trend, is what I would call consumer insights. And so how much does the world around me know about my preferences for dining and menu selection and seating and service and time in line and time at table? And, do I want to have a waitress at the table or a waiter, or would I rather not? Do I want to have an iPad at the table? And so I have a set of preferences around how I like to dine, where and when and how. And when the world begins to understand that and deliver to me what I want, I think that becomes interesting. And we've seen a little beachhead in this notion in one of our brands called Swig, where your personalization of your beverage is the hallmark, that is the secret sauce, that is the black box of Swig, is that when you arrive at a Swig, we know who you are, we know what you want, we know when you were there last and what you're gonna want next, and we know your name, and we can deliver a very personalized experience at Swig, more so than we can, for example, at Mo Betta's or R&R. But I think directionally, that's been interesting for us to watch Swig really develop themselves in that regard, using technology and customer insights in that way. And I think the industry will trend that way. So there is a set of technology around convenience and performance and supply chain and management and oversight. But I think the one that I'm watching is around customer insights.
This has all been incredibly valuable and incredibly insightful. And now, just as we wrap up, my last question for you, we've kind of covered this a little bit, but I want to make sure, for so many people listening to this, I mean, this is a unique opportunity to get the perspective of folks on the other side of things, of the private equity relationship. So for you guys, if you are to talk to an emerging restaurant operator who is, navigating the pandemic today and has one eye on the future, what's the thing that you would advise they do right now, go and do right now, so that they can set themselves up for whatever success and potential and deals are to come?
I'm going to give you three, but I'll give them quick enough that it'll feel like one.
Okay.
The first is be ready for change. Embrace it. Love it. You have no choice. Don't resist it. Don't think about the way things have always been done. Think about the best way to do things going forward. The way things have always been done is less important. Follow your customer's lead. They will tell you what they want, and you can just deliver it to them, but it'll involve change because they're changing. So that's number one. Number two is, if you're thinking that private equity would be interesting at some point, or a financial partner, then organize, systematize, simplify. Don't create something that you feel like is kind of a black box and mysterious and only you can do it. That's going to hurt you in the long term. The more you can take the art and turn it into science, the more you can take the black box and turn it into process and system and write it down and put it in a binder for your teammates and partners to follow, the better off you'll be. There will become a mindset when you'll adapt from thinking of yourself as somebody who serves food to thinking of yourself as somebody who opens restaurants. Your core competency will have to change from I'm cooking, I'm developing, I'm delivering on a plate, to I'm identifying markets and I'm delivering a valuable service to those markets to which they will become loyal. And my third one, and this is a little bit of tough love, and it's mostly for me sort of watching news and so forth. I hate to say it this way, but stop whining. Like we get it that the food and beverage industry is changing, but complaining about it, looking back, describing how hard it is, no one wants to partner with somebody who's unhappy and dissatisfied and feeling helpless. Nobody wants to fund somebody or work for somebody or have somebody in their strip mall who has that kind of attitude, defeatist. I'm trapped, I'm locked up, I don't know what to do. I'm not being treated fairly. Deliver your experience, develop your team, take your place in the market, be responsive, be optimistic, take the new environment and build something that works. And then everyone will want to partner with you. They'll be excited to be on your team. They'll want to help you develop. They'll contribute to your ideas and your success. And it'll be a win for everyone that touches your idea.
Wow. Very, very practical. That was awesome. Andrew, what do you think?
Mine's going to be from a quick story, and it's going to also just be under 60 seconds here. So I was sitting about a week into the pandemic in March, and we were just watching numbers drop and people just stay at home, and we're trying to figure out, do we shut down stores? Do we furlough employees? Do we fire? And there was a moment in time where Greg, sitting with 15 of our team members around our board table in our war room that we called it every day, looked at me and said, we got to change this. We got to change the tune here. And I said, I agree. And so everybody got up and walked out, and Shauna, our president, and Greg and I sat there and said, we're going to go on the defense and or go on the offense instead of being on the defense. And I think that has carried us to this point now where we've been on the offense and not been in the defensive position. We've been on the offensive position since then. I don't think that's just during the pandemic. I've always felt in my mind like I'm on the offense with what I'm doing, what I'm building, what I'm growing. And I think so many people have been put on their heels that they're on their heels still. And we can see that, and we can tell that when we're talking to you. Be on the offense. And I think that with Greg saying stop complaining, it really is true. Be on the offense. There's opportunity ahead of you. So get after it. So number one, be on the offense. Two, in my mind, don't think growth by adding more units or going and getting the next black box that comes online and you think it's opportunistic and I better jump on it before someone else takes it. Sometimes growth is only going to augment the problems you have. And we see that too. Make sure you perfect and clean up your house that you have. Now, get your house in order because that's what's going to be most important to us. How your team pivoted during the pandemic and got their house in order is more important to us and more impressive to us than saying we have 5 stores in development or 3 and we're crushing it. Well, you're really not crushing it. I wish your other 3 or 4 stores you already had are crushing it. That would make more sense to me and Greg. So get your house in order and be on the offense always. That's
great. Lots of stuff to unpack here for folks that are listening. So Greg, Andrew, thank you guys both so much. This has been a real pleasure to be able to do this Restaurantology series. Some incredible insights from your operators and from your team. So thank you guys. Take care and be well.
Thank you. And same to you.
Well, there you go. That is the 5th and final conversation in the Restaurantology series with Andrew Smith and Greg Warnock, the managing partners behind Savory Fund. Again, if you haven't heard it by now, these episodes are going to be available on demand, both on the Fast Forward podcast feed, available at Apple or Spotify or wherever you listen to your podcasts. But you can also stream the videos of these panel discussions. Those are going to be available on QSR's website, but also at savoryfund.com/restaurantology. I highly encourage you to, if you haven't listened to this whole 5-part series, please go back and listen to the whole series. You can share the series with your friends if they're also emerging restaurant operators in this space, as I think this is really valuable insights to get, especially coming from the investor side of things. These conversations are important to be having now during the COVID-19 pandemic and setting this industry up for bigger and brighter things ahead. Thanks for joining me on this 5-part series of Restaurantology. I'm excited for more episodes in the Fast Forward podcast coming to you in the coming weeks. In the meantime, please feel free to contact me anytime you want to talk or share your perspective. sam@qsrmagazine.com. It's been a pleasure sharing these with you, and I look forward to talking with you again soon.